Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. Trump's tariffs are now in motion. North American equity markets are off, and this is following the implementation of the 25% tax on goods from Mexico and Canada into the U.S., along with an additional 10% duty on Chinese imports to the U.S. So with market uncertainty unfolding in real time, dividend investing takes kind of a center stage at this point, offering investors stability in pretty volatile times. As we see a shift in market dynamics, how is our next guest spotting the best dividend opportunities without taking undue risk? Joining us here today to discuss his outlook for the months ahead is Fidelity Dividend Fund Portfolio Manager, Don Newman. Don, welcome. Great to see you.
Nice to see you too, Pamela.
Great to have you here. Let's dig straight into this.
Sure.
The tariffs have arrived.
Yep.
I think everyone sort of hoped they might not have. Tell us a little bit about what you've been doing to prepare for either this reality or some other, but you've been preparing for tariffs for some time.
This is something, it's an unfortunate circumstance. I think we were talking about it a little bit before the show, but tariffs are an effective tax on the consumer. They're a tax on the Canadian consumer, but they're also a tax on the U.S. consumer. So this is sort of this is a lose-lose situation, and what you want through trade is really a win-win situation. So, I mean, what we've been doing, our analysts have all sort of been tasked, and we've been looking at this for sort of months on end of, where's the exposure, what companies are exposed, sort of who gets hurt from this, who doesn't get hurt from this. Is there, anyone that sort of is, relatively immune, that in the case these tariffs do get put on, we can potentially sort of either hide or sort of make some money on people having to come out of potentially the tariff losers into tariff sort of relative winners. And I think we talked about it. It's sort of like in an uncertain world. What I'm thinking about right now is sort of, if there's uncertainty out there, let's maybe tilt a little bit more towards certainty while this goes on, while keeping an eye on securities that become probably unduly cheap, and we have some big upside to come over the next couple of years.
Okay, so really interesting. We'll get into that
Yep.
piece of it. Is there a premium that's willing to be spent on some safety, some defense, some stocks that would post
not
regular dividends?
Defense, but I think if you look at sort of the way I'm thinking about things now, it's there's usually variability in outcomes for stocks.
Sure.
And in times when you have increasing uncertainty in the market, what I generally look at as a dividend manager and someone that's sort of focused on at least buying companies at reasonable prices is bringing in the variability of outcomes a little bit. So sometimes you can find things where you think there's going to be a really good upside, not too much downside, but there's variability. The way I'm kind of thinking about things right now is there's a little more uncertainty in the market, so let's go and tilt things to companies where maybe I think they grow 8%. If I'm wrong, they actually grow 7% or 6%. What I'm trying to avoid right now is companies where the market thinks they're going to grow 20, and it turns out they're going to grow 2, and that's a really bad outcome for the stock. Okay. So we'll look a little bit more for the certainty of earnings, the certainty of dividends, and the increasing of dividends. Tilt the portfolio that way, and then think about, okay, work with our analyst. Who's getting hurt off this, but where's how low can the company go, or where's a really good sort of buying point for the company? And if they hit that, then say, okay, maybe we'll tilt back a little bit, and we can ride out a little bit of the storm and then hopefully make a lot of money on the upside. And this is where hopefully active management and the fact that we've got all these analysts doing the math on every company in Canada and most of the companies in the U.S. and around the world, this can come and sort of provide sort of really good active returns over time.
And you're getting paid.
And you're getting
paid, which in a moment like this is not a nothing.
Yeah, and I think there becomes sort of a little bit of a premium for certainty. And you can see sort of money flows into companies now there where the dividends are good. I know I'm getting a dividend. We know the earnings are not really particularly affected by tariffs. So we'll pay a little bit more for those companies. And those companies, and we had a huge sell-off yesterday, and there were actually a number of companies that had those characteristics that actually went up on an absolute basis, as opposed to even down less and clearly not down nearly as much as the market.
So tell us a little bit about that. We can hold on for a bit, or the story of how long the tariffs are there, because you must sort of be looking. They're fine for a month, okay for 2 months, and then...
So this just becomes, the tariffs really, and now it's a duration story. So the impact of things, if this is on for 2 weeks, things will bounce back very, very, very quickly. And cooler heads prevail. The U.S. takes their tariffs off, we take our tariffs off. All these gaps, as a reasonable person, you would think the gap shouldn't be that large. Dealing with fentanyl shouldn't be that much of an issue. We should be able to come together, and instead of having a lose-lose situation, come and have a win-win situation. If it's a couple weeks, 3 weeks, a month, this all can be sort of dealt with, and things will bounce back very quickly. What you really hopefully don't have here is a protracted trade war in which companies, as a CEO, you're sort of sitting there going, well, am I building that new plant? What kind of capital expenditure am I making the next year? And uncertainty doesn't help you invest. And so uncertainty is bad for capital spending and investing in the economy, both here and in the US. And the longer this goes on, the more CEOs say, you know what, I'm just going to pull back. I'm not sure what's going on. And that sort of plant that I want for the next 15 years, you know what, I'm going to defer it for a year, I'm going to defer it for 2 years until I know what's going on, as opposed to, if this lasts a couple weeks, hey, I've just spent a couple more weeks looking at things, still going ahead with it, everything's great, let's put the money in the ground. So you want the money being put into the economy, and you want CEOs and companies that are running businesses, or people that are running businesses, to be able to have that certainty to invest in the economy.
Don, is it helpful, the uncertainty, to your fund, in the sense that people will be rotating? I mean, we've seen rotations already, with a few different reasons for that. But the market's been rotating, leadership has been shifting. Is this a moment actually you see quite a number of inflows, probably?
Yeah, this is sort of where hopefully a good dividend fund can sort of help out investors. You've got a little more stability, you've got a little more certainty of earnings, you've got a little more certainty of outcome, and you've got the yield that sits there. And frankly, if the economy slows because of this, it's probably, you may see rates come down a little bit. You could see people sort of saying, okay, you know what, that yield actually looks really attractive in an uncertain world, and you build up, you bid up the certain yields. And if the certain yields are priced reasonably, which in most of the sort of the dividend fund space, they are, at least hopefully a lot of the companies that I own in the portfolios are, then you can have sort of a rotation into those type of securities. And we've actually seen that over the last sort of couple days and sort of week or two leading into this.
Tell us a little bit about the companies that you have in there. You can go a little bit to your top 10, but the types of things that, I mean, frankly, would be termed value stocks at this stage. I know that's not really your style, but there's some companies that, have missed the massive run-ups that we've seen over the last couple of years, and this rotation has been taking place.
I think it's been one of the things, or a couple of things I'm kind of looking for right now is exactly that you said it, like companies that haven't run as far as the S&P 500, companies that haven't gone from 15 to 25 times earnings. And a lot of that in the dividend space actually is very understandable, in that a lot of really good companies that were dividend payers had to contend with a few years here, especially 22 and 23, when rates went effectively from almost nothing up to 5%. And suddenly you had to compete against different asset classes, in bonds, in money markets, in anything that was secure, and frankly, some short-term funds that could give you a 4.5% or a 5% yield. And so the companies didn't appreciate as much, because while their earnings were growing, their multiples compressed a little bit to compete against other asset classes, and the yields went up. So I've given an example of like utilities. In the utility sector, I think I looked at it this morning, and like utility sector is 12 to 15% above where it was in 2019. That's 5 years.
There's a whole other story in the utility sector right now.
Yeah, 5 years of appreciation, sort of a little bit wiped out with rising rates, but at the same time, like fundamentals are as good as they've ever been, and most simply because you've got AI, you've got reshoring, you've got just movements among different states and provinces. But demand is about as good as it's been since the 1960s with the advent of the personal air conditioner.
So, really?
Yeah,
is that what that?
Yeah,
okay.
that's I've talked to one of the U.S. CEO, and I asked him, listen, when was the last time fundamentals have been this good for you? He said a little bit in the early 2000s, but you really have to go back to before any of us were actually working, and the last time they've seen this kind of demand, or what they refer to as low growth, is the advent of the air conditioner in actual people's homes. So, and a lot of that comes in with AI, and the demand for electric energy is absolutely massive now. And at the same time, you don't pay a huge premium, and none of these companies are exposed to tariffs.
Right.
So it's and the yields are pretty good. So there are places where you think about, you can go and say, okay, I'm not exposed to the current situation. I can hide there for now. I think the fundamentals are actually good, so I'm not hiding in bad companies. I like, my whole thing is good companies at reasonable prices that can maintain and grow dividends over time, and I sort of think of myself as a GARP investor, which means growth at a reasonable price, but I focused really on the reasonable price segment of things, so that I can get decent growth, but I don't, if anything goes wrong, I don't take too much of a hit on the multiple, and we keep people's capital intact.
When you and I spoke, I think about a week ago, just thinking we'd have this conversation, so on. I mean, the markets are moving so quickly; it's hard to have anything that holds water in terms of discussion. But been talking about how the market hadn't had a really big pullback. Like there had been pullbacks, but the dip buyers were so
3% here,
fast,
4% there.
right?
Yeah.
That it wasn't really material.
Yep.
What are you seeing right now? I mean.
So, obviously the market doesn't like the sort of the contentious environment that's going on between multiple different countries right now, and mostly with the U.S. administration. If there is a pullback, that's the time, hopefully, where active management, we're kind of set up for this, and you hopefully protect the capital a little bit on the downside. But then if you're sort of a long-term investor, these are the times when you actually get the opportunities to buy really good companies at great prices. And it only happens every so many years. So you think about the pandemic, awful thing to go through, was the absolute best time to buy stocks in the most painful environment. You're stuck at home, you can't go anywhere, the world's ending, and you got the sort of the deal of a lifetime to go and buy things. Hopefully this will be nowhere near that. But right now the situation is, we've got tariffs going up on either side. It's not good for certainty. It's not good for the consumer, but it also creates a place where active management can do its work. You can find the companies that are not exposed. You can find the companies that are exposed. Look at the companies that are exposed coming down to levels which are like, hey, this is a really good company. We knew it was exposed, but I'm not going to get to buy it at this level for maybe another 10 years. Why don't we go and take a look? And that's the job of our analysts. And we have analysts on every sector looking and going through and sort of doing the math on like, where does this make sense and where do we put the pin in?
With markets driving down further, is it an opportunity to buy, which you've pretty much said? I mean, it's always hard to know where you're catching a falling knife, and you guys know how to do that. But this doesn't feel finished at this point, is it? What do you think?
I think from the standpoint, my standpoint is a little more stability right now until I've seen sort of the back and forth and what everyone's coming out with, and then whether we can get to a point where you slowly get to like cooler heads prevailing. And I think, if you start seeing markets go down, I don't think the U.S. administration particularly loves that. I don't think that anybody loves that. No. And there are reasonable things. Reasonable people should be able to come together and sort of make a bad situation a lot better. Trade should be a win-win situation. If we go through a little bit of protracted time here, I think you want to go, and that's quite possible, you want to go for a little stability right now, and then start picking off the names the companies that you've always wanted to own, that are getting, and we'll have points where I'll be saying, okay, at this valuation, this company over the last 20 years has only traded here a certain amount of times. Every time it gets to this level, and we've got and the earnings, we can put a pin in the earnings. This is a great time to buy it. And that's the analysts are constantly going through that. I'm not jumping on anything today because I want to see fulsome disclosure of what everyone's coming out with and what the U.S. administration is response to what Canada's doing today and what Mexico's doing. Get a little bit more of a flavor for where we're headed here, and then we can start really taking a look at, okay, well, are we hitting any of our points on some of these stocks, and start maybe building some positions.
Okay, that's really fascinating. Is one of the other pieces of the so-called Trump trade, which I think we've effectively seen wiped out at this point, or we're sort of back to the levels of November and so on. But a big piece of it was deregulation, which was more a discussion about the U.S., of course. But do you feel like probably around the world that it's a little bit of a theme, a discussion? Is it something that you look to when you're looking at companies that may have a lighter load at some point?
Yeah, I mean, I think the initial thought from the U.S. administration was really good. The idea of a little bit, you don't want to take it too far because there needs to be some regulation, it can't be the Wild West, but allowing companies to invest without too much red tape and being able to do so at a reasonably fast pace is a good thing for markets. And that should be one of the things that continues. Like deregulation is a really good policy. Tariffs are a bad policy. So we want reasonable deregulation, and then hopefully the tariffs can be pulled back a little bit. And that's a great, really good situation for the markets.
A couple of questions about the fund itself. So what's the difference between the plus and the non-plus dividend fund?
So as I think I've talked about this in the past, but historically, Dividend Plus, if we went long time ago, like 15 plus 20 years ago, was our income trust fund. And it tends to be a little more sector specific. And Dividend Fund tends to be a little more of a broad-based dividend fund. So think of Dividend Plus as a little more infrastructure-y. So it's like pipelines, utilities, REITs, maybe a little bit of a higher yield, a little bit more interest rate sensitive. So if you believe interest rates are going down, and there's a little bit more probably stability in cash flows there. So in a scenario where interest rates really come down, Dividend Plus tends to be okay. I generally get asked if you're going to invest over a long period of time, there is a little bit of actual Dividend Plus in Dividend fund, so that the two worked as complements to each other, and having this diversity of both funds in one fund, which is Dividend Fund, tends to work well for advisors.
Okay, that's really helpful. Okay, talk a little bit about your universe, where you can go around the world. Lots of discussions about the everywhere else trade. That's been a discussion, but give us a sense of your universe. Where can you go?
The universe is mainly Canada, some U.S., occasionally Europe, but it's basically wherever our analysts can come. I'm always going to be a Canada-centric fund, but we have a whole U.S. research group that sits with us. We've got an international research group sitting over in London, England. So wherever the ideas are best, and if someone can pitch me a really good idea, it doesn't really matter where in the world it is. It tends to be focused because I know the market's best in Canada with some U.S. But if the ideas are good and someone comes by my desk, which hopefully is happening multiple times a day, and the pitch is good, we'll go over it with the analyst and hopefully get it in the fund.
That's great. Okay. Let's go into some of the areas where you're investing. So I think you said rails, you mentioned REITs already. What's the story with transportation broadly? There's some areas that actually
transportation is going to be an area, at least in the short term, that's a bit of a tariff loser because you've got intermodal things moving between Canada and the U.S. and people are worried about an economic slowdown. Having said that, it's one of those things that probably sits at the top of my list for these are really good businesses. They actually, if you look at rails, both Canada and the US, they haven't done a lot for the last sort of 4 or 5 years. Volumes have been tepid. There hasn't been a lot of improvement in what's called their operating ratios. But they're really good businesses. No one's ever going to build another rail again. So it's sort of like an oligopoly, a competitive oligopoly that has massive barriers to entry. You can't build another rail. And the one argument has just been valuations have held up pretty well because everyone knows they're a really good business. But if that can change a little bit and people get worried about tariffs, they get worried about volumes, they get worried about the economy in general. Rails are economic sensitive because it's P times Q. If the quantity goes down a little bit, but the valuations get really beaten up, they're good businesses that are going to be there. If you ask me about a business that's going to be there 100 years from now, they're going to be there 100 years from now. So it's like a top of the list on the sort of little more economically sensitive that may get beaten up, but if I can finally get at a reasonable multiple, they probably go up in the fund.
Really interesting. What areas of REITs, of real estate do you like? I mean, we're actually hearing a lot about lumber, of course, and building supply and new houses in the US, as much as Canada. It's a big story. But tell us a little bit about the areas of real estate you like.
So there's some real estate is actually fairly interesting because it's an area that hasn't moved too much over the last number of years. Did really well in 2021, but what you had then is an economic scenario where rates were close to zero and demand was actually really good. So what happened in a number of the sectors, and this happened in multifamily, certainly down the Sun Belt, it happened a little bit in industrial, is you had cheap financing. And you could go out and you could build a lot of stuff. So a couple of these sectors, some multifamily down in the US and some sort of industrial, both in Canada and the US, got overbuilt for a couple of years. And that means that supply came on. What's happening now is a completely different environment. So for the last year or two, it takes multiple years for these things to kind of work through the pipe. Rates went up a lot. So financing became really, really expensive, and there was a little bit too much supply in the market. So basically, supply kind of rolled over a lot. And that's the case. So that makes it interesting to kind of start looking at multifamily, certain in parts of the U.S. Industrial, the supply started to roll over a bit. Industrial economy may slow down a little bit, but the supply is coming off a lot. So interesting sectors that where things actually will get better this year as opposed to worse. Another one is just retail, and it's been really interesting talking to some of you think about, retail is very sensitive to the economy. Well, there's been really no new supply in retail for the past decade.
Is this Canada, US?
Canada and the US.
Because it's
really interesting.
Over-malled.
Yeah, we were over-malled, but the populations have grown immensely, and no one's built anything. So if you go and talk to anyone who's kind of grocery anchor retail, they got rid of a lot of their bad tenants in 2020 when anyone who wasn't strong enough to survive didn't make it. So the tenants are all really strong. No one can build anything. As I was talking to one of the CEOs down in the US, and what he was saying is, Don, listen, if I wanted to build a new sort of retail strip mall or something like that, my rents need to be 30 to 40% higher to justify the cost. I can't do it. So there's no supply coming on unless rents go up a lot. So the existing people who tend to be stronger tenants are paying sort of consistently higher rents. Supply and demand is really good. And the tenant base is actually stronger than it ever has been, and the companies are yielding sort of really good returns. And everyone's like concerned, I'm worried about the economy a little bit. The tenants are pretty good, the yields are good, and the valuations are actually pretty reasonable. So there are things out there that look reasonable, that are stable, that are going to keep paying their dividends, and the stock prices are not well past or at the sort of the top end or higher than they've ever been.
That's so interesting. Okay, let's spend the last few minutes talking a little bit about when stock markets can go and companies and the swings of the market can go from absolutely terrible to a bit better, and what that means to your style of to anyone's investing, how powerful that can be.
Sure, I think
Because this is a moment of terrible.
The world has gone through a lot of bad things.
Yes.
And the stock market continues to appreciate over time. So I think Fidelity always has these, the charts that throw like, okay, here's the world wars, here's a pandemic, here's a financial crisis, and guess what? We tend to get through it, and during those periods, you end up finding stocks that are really good businesses that come on sale, and they only come on sale once every 5 or 10 years. Hopefully this is not a once every 10 years and this gets really solved really quickly. But if we do have any glitches, this is when it becomes really interesting to be an asset manager, because I finally get to go and say, hey, I've been sitting on the sidelines for that company forever. I wish I could buy it, but here's my number for it, and it's not there. And then suddenly it hits that number. And I remember in 2020, once again, I won't compare this to situations, but I had this whole list of companies, and it was like, I'm never getting there, I'm never getting there. And then in a month, I got there on like all of them. I got there, and it was just, I was sitting, my hands were blowing up buying stuff in March and April of 2020, going, I'm never going to get to buy this company once again, I hope this situation is not comparable, but it's the situation hopefully Fidelity is designed for. We've got the analysts looking at everything. We've got portfolio managers who've been here a long time. Volatility can be really good for us because we know how to mitigate volatility, and we can also go in and take advantage of volatility when the prices become attractive, and we can buy companies that'll make us a ton of money over the next 2, 3, 4, 5 years.
This is what you do.
Yep. This is what we do.
Quick question to close out. This is on currency.
Yep.
The discussion of, so the currency, is there a strategy that you use? Are you hedging ultimately?
Generally not. It will be, unless we're at complete extremes. I generally look, currency moves, 5% here, 7% here. Those are huge moves. Generally it's a couple percent. There's been a big move down in the Canadian dollar. But if I can find a company where my analyst is saying, hey, I've got 40% upside, a 5% move in the currency doesn't matter to me. I will take the 5% move in the currency. Stock moves are always going to be bigger than currency moves. And if you can pick the stock right, generally the currency will have a little bit of an impact, but it's not. The biggest driver of your return is always going to be the stock picking.
Okay, fantastic. Just a final thought from you, Don, on what you want everyone to know that you're in the midst of doing right now, the sort of
I think this is going to be a great case for active management. This is what we're here for. This is why we show up to our job every day. This is why we have analysts that know the companies better than anyone out there. This is why having a good dividend fund that's has a little more stability, hopefully in it, that can generate a good yield, can add some relative stability at times, but also go and find some upside when things get a little bit shaky. But the shakiness means there's some opportunities out for us to buy. So this is what Fidelity is hopefully set up to do. This is why we put so much resources into having really great analysts that do things, having portfolio managers that all work together and have been working together for, a decade or two. This is hopefully what we're here for clients to do. Okay. And I think makes a great case for dividend equities being sort of a core part of people's portfolio, because they offer yield that's not going away, they offer some stability, and they offer good appreciation over time.
Yeah, all those sound like a good mix of ingredients at a moment like this. Don Newman, thank you for joining us.
Thanks, my pleasure.
Yep, great to see you.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.